This signal rarely moves markets immediately, but when political pressure targets credit mechanics, it can change how fast the next phase forms. And by the end of this video, our strategy will explain whether this matters at all. In our strategy, risk is tracked through a 5-phase cycle. We do not trade headlines. We track whether signals transmit into liquidity and credit behavior. This episode reviews a video discussing a proposed cap on credit card interest rates. The original creator focuses on realism and institutional power. This breakdown maps that claim into the Our Strategy framework. Here is the core claim. A 1-year cap on credit card rates sounds helpful, but the system is unlikely to absorb it as stated. Credit card rates are priced from funding costs. They are priced from default risk. They are priced from contracts, not speeches. If margins are threatened, behavior changes. Credit access tightens. Fees replace rates. This is where most people miss the signal. Relief narratives often precede tighter credit, not easier credit. In our strategy, that pattern fits late Phase 1 behavior. Public frustration rises. Mechanical stress has not resolved. This does not confirm Phase 2, but it raises sensitivity if paired with real changes in lending behavior. Hold this thought. Markets only react when balance sheets react. If banks restrict credit, consumption slows. That pressures earnings. That eventually pressures risk assets. Without that chain, this remains political noise. Important to hear, but not yet actionable. Quick disclaimer, this is educational macro commentary only. So what actually changes? Our strategy increases focus on credit behavior, not on policy promises. What does not change? No phase shift, no opportunity window. This signal matters most for financial sensitivity, not as a trade, as a stress indicator. Here is where it becomes actionable. If credit tightens, duration becomes more sensitive, equities become more fragile. Tickers to monitor if this persists. SPY for broad risk sensitivity, TLT and ZRAs for duration response. These are not buys, they are the tickers most sensitive if this signal transmits. Probability update. Phase 2, risk remains moderate. This nudges sensitivity higher, not certainty. Proximity matters. This is not a buy window, but it is no longer distant if credit data turns. Here is the analytical question to leave with. Does consumer credit tighten first, or does this narrative fade? That answer determines sequencing. We do not need to be early, we just cannot afford to be late.